thank you all very much for being here. I think we have the honor to be the very first session in this strange staggered program that we've arranged. So we should set a good example, I think, by starting more or less on time. I imagine there may be a certain amount of walking in and out as people go to various sessions and come in and so on. So we will be tolerant of that, and so don't worry about giving offense if you do walk out at some point. We won't assume that it's because what we have is so dull. So what we're going to do is we have two main speakers, both extremely distinguished experts who have devoted substantial, long academic careers to studying inequality around the world. Branco Milanovich from Yugoslavia originally, but from the World Bank, and I'm sure nearly all of you are aware of his many works on this, and Vamy Valu Branam from University of Massachusetts, and then Christina Anoman will make some comments. I will really just confine myself to asking for comments from the floor. I think the idea is that you each speak for about 15 minutes or so, 20 minutes perhaps at most, and that will give us plenty of time for discussion. So without further ado, Branco.
Thank you very much, Anatol. First, I have to find out how I can move these things, the PowerPoint, but I hope we'll find out. Is it here? Okay, great. It is there. Well, it's miracles, yeah. Well, anyway, thank you very much, and thanks to everybody for coming here. It is a first session, actually, and some of you who are familiar with my work, of course, might have expected that I will speak about global inequalities. Obviously, this is a topic I've been working and speaking for many years, but since this session was called something about, within national inequalities, obviously I worked on that as well, but not as much. I decided to present something which is not yet in a written form, which I cannot give you as a paper, but this will be a chapter 2 in my book. It's too long to explain how the book is organized. The book is really dealing with global inequality, but it has one chapter which deals with within national inequality. And this is actually what I would like to present today. It's like the second time that I'm presenting this, so it's actually pretty new. How can I do this? Is it this one? Green one? Yeah. Okay. So let me just stand up. So I'm going to discuss, actually not to put too fine point on it, I'm going to discuss what I call, actually there is a sort of definition there, what I call the Kuznets waves. And I will discuss them very briefly because we have 20 minutes, or, Anatol, you let me know when I'm like 3 minutes off my time. Okay. Kuznets waves in the pre-industrial societies and industrial. Now, the essential story here, which I will just tell you now, the sort of a main line, is that I believe that one can make a reasonable case that we are now facing what I may call the second Kuznets wave under the conditions of rising mean incomes. In other words, after the industrial, you can see the industrial revolution. Before the industrial revolution, you can have a basically flat income level, average income level, and around that you will see quite a few examples of a Kuznets wave, meaning inequality going up, inequality going down, and I will talk a little bit about the forces which push inequality up or down. But the mean income level is fixed. So if you do the standard Kuznets approach, where you actually plot changes in income distribution against the mean income, you get nothing because that mean income is simply, fixed. So essentially, what you have on a graph, you have lots of points which have no meaning. Now, it's only when the mean income starts growing, so basically we can say after the beginning of the Industrial Revolution, that the mean income goes up, and then you have, of course, we know quite well, the first Kuznets wave, and I think actually we can see something which I try to interpret as the second Kuznets wave. So basically these waves then go around a mean which is increasing, which is actually sloping upward. So let me sort of go and explain a little bit what I have in mind. I will actually skip very quickly the slide which talks about disenchantment with the Kuznets curve. As you all know, the disenchantment really starts with the results from late 1970s, 1980s, where the rich countries almost uniformly show increases in income inequality. So that obviously is very difficult to square with the original Kuznets hypothesis, where actually increase in mean income should have continued to be accompanied by unchanged and relatively low inequality. So it is really that part which I'll skip actually what Kuznets says in 1955. This is actually quite well known. So, I mean, if you really can read it very quickly, you can read it, but, you know, otherwise it's really not going. But, of course, the emphasis is on narrowing of intersectoral inequalities, the decline in the share of property. That's exactly the opposite of what happened. Actually, we know that from Piketty's work and the others. And the institutional changes that reflect decisions concerning Social Security, which, of course, again is the opposite of what happened, because the redistribution function of the state has become less progressive than we believe. Now, let me just go straight into the what are the key points. The key points were it was the first theory of movement of income inequality, which actually explained gave some sort of stylized picture of how inequality should move, and it was a big departure from the other theory that we had at the time, which was Pareto's, where actually inequality should be really fixed, and essentially Pareto's claim, as you know, that there is what I may call the iron law of income inequality, which holds in almost all countries in the world and all societies. Now, this is how really Kuznets looks today when you do a cross-sectional thing. So really, you can plot something which looks like a Kuznets curve, but there is really lots of data points all around. But, you know, it was never like that. The Kuznets planned to have it studied. Actually, he always wanted to have it studied on the case of individual countries over time. So this is actually the two countries where we have probably the best data, although I'll show you later a few other countries have quite spectacular data as well. This is the UK, the blue line, and the US, the red line. Goes back to 1688 approximately, I think, for the UK. This is based on social tables and the work that I did with Peter Lintert and Jeff Williamson. And of course, when you come more to the 20th century, it is based on household surveys. So what you see there is very, I mean, I think somewhat clearly, is that actually there was an upsurge in inequality. In the UK, UK is a prototypical case, obviously, of a country that has been the first to undergo the Industrial Revolution. So you see the peak around 1860, 1870. I think it's generally accepted. Then the decline, a very rapid decline. You will see that later, maybe if we have the time. Really, UK has a phenomenally strong decline over the next 90 years or so. And then, of course, the trough of inequality, which for both countries happens around the same time. And then I will show you data for Spain, Italy, Germany. They all show, obviously, as we know, the minimum around 1980s, and then it creeps up. So the problem there is that, of course, you have that same graph. This is basically the Kuznets frame. This is what Kuznets saw when he wrote, because obviously he could not see the future, so this is essentially what he saw, and it seems pretty reasonable that this should be an inverted U-shaped curve. Well, this is actually what they call the Piketty frame, which starts from around early 20th century when you have fiscal data, and you see exactly the opposite. You see actually a U-shaped curve. So obviously, I'm not going to explain, Piketty's explanation, but I just want to point out that there are really two different stories there. I think actually we should go further into the past, and that's one of the things that I would like to do, is actually look to the data going back to the Middle Ages, because there is a huge development in the empirical studies of Europe, essentially Northern Italy, the Low Countries, and so on, which look at inequality in the past. So basic, I think I've already said that, is actually think of the modern Kuznets curve as being driven by two technological revolutions, the Kuznets curve 1 and the Kuznets curve 2, which starts around 1980s. So the obvious reason there are three things that you can argue there happen is globalization, technological revolution, the IT revolution, movement of labor from manufacturing into much more heterogeneous services where you actually cover an incredibly wide array of people with very different skills and income levels, which increases, of course, inequality in wages. So it's that movement is very similar to what Kuznets originally had as a movement from agriculture to manufacturing, which would increase inequality. So here we have movement away, out of manufacturing into services. So let me just show you some graphs for the countries with mean income, with stagnant mean income. This is data which is based on the rental wage ratios. Obviously, we don't have Gini coefficients for Spain in 1200, you know. So this is based on Leandro Prados de la Escadura work. And one thing that I would like to point out, which actually will come now very strongly in a few other things, is the effect of plague and different epidemics on reducing income inequality. So this is what I call, I'll show that later, what I really distinguish between the malign forces and the benign forces. There are two forces which reduced income inequality. There are malign forces of war, which we see also in Piketty's work, and which we know, I don't need to explain that, civil strife, political instability, and in the past, particularly strongly, plague and epidemics. And that we see in the Italian data and in Spanish data very clearly. The mechanic there, as you know, is the reduction in labor force, the increase in the wage rate, and the reduction in inequality. And for the others, then, of course, we see the recovery. There are other explanations. I put some of them for the Spanish recovery. But this is the interesting part. This is the same graph. But it is plotted. The first one was plotted against income. So you see actually very nice Kuznets type of movement. Now, I plotted this graph. I'm sorry, the first one is plotted against time, so you see very nice movement in time. Now, I plot the same numbers against income, which actually, according to Kuznets, I should do. And this is what I get. So basically, you get nothing. And the reason why you get nothing is because mean income is simply fixed. And then around that mean income, which really varies 20%, you have a bunch of numbers that are distributed, a bunch of points that are distributed in a sort of a random or non-uniform fashion. So let me show. This is a very striking graph. This is plague in Italy in, that was the big one, about 1350. Data come from the villages in northern Italy. Very strong dip. Actually, we find the same dip for Florence, wherever base, and there is another plague in 1650 with the same result. So these are you know, also these dips here for Italy, for 5 northern Italian cities. The data are from Guido Alfani. And you see then, of course, a rebound of inequality, but you see these malign forces driving inequality down. So let me, this is for the, this is Wouter Rickbosch from the 5 low country cities, and that work is actually continuing. Now let me go for to the present. Let me first define the malign and benign forces reducing inequality. I already mentioned them. In the historically, with societies with stagnant mean income, you have really wars, destruction, epidemics, civil conflict. Then, of course, among benign forces, I put something which I'm not quite sure whether we'll be able to do much, but it's really cultural and ideological norms. You can actually think of whether Christianity had a sort of inequality reducing effect. I mean, you know that many people actually, with large fortunes in Roman Empire, actually gave money to the church. No, I'm not sure really churches and even technically churches would not be included in surveys or any data. So I'm not sure how that will be treated, but certainly on the personal level there was some reduction of large fortunes. With the societies with rising mean income, we have the same practically malign forces, maybe much less of epidemics now. And then we have the usual ones, which are essentially the forces that Kuznets identified. So I'm not going to read them. But of course, the very important one is, of course, one which actually we have not seen much, is low skill bias technological change. I actually want to bring this to your attention because we essentially assume, and it is true historically, that we have machinery replacing routine labor or low-skilled labor, and technological innovation is always sort of enhancing the returns to higher skills. It could be, we should actually think, I've come with 1 or 2 examples of technology which might actually have the opposite effect in reducing inequality, but we don't find it very often. So let me show you the Kuznets relationship very briefly. Do I have, How many minutes?
10 minutes.
Oh, 10. I'm very well. I'm doing well. Then Kuznets relationships for the key countries that I have long-term data. And if you can read, it's a small number, small digits there. But you know, this is, again, as I said, for the UK. I start with UK for obvious reasons. You have this upswing, and then you have, of course, a very long downswing. Unfortunately, we don't have too many data between the two wars in the UK, and then from 1962, obviously, we have very detailed data, and you see this trough in 1979 very clearly, and then an upward increase in inequality. Nothing new, except that it really goes, you know, longer in time. In the US, thanks to work by Lindert and Williamson, we have now a new book which is coming out. It actually does. They show inequality in the US just before independence, just before the Civil War, and then you see this kind of weird pattern there. There is some debate about that. There is no debate that the GDP went down, so that actually shows you as a leftward movement, which is unusual. You know, we are actually not used to seeing really declines. It shows also in 2011 and 12 and 13. You see this kind of strange movement because it goes left. And in this particular version of the graph that I've decided to choose, to select, 1933 is the peak. Other people argue it could be 1929. But basically, we are talking about US peak, which we knew, which comes about like 60 years after the UK peak. And as you know, probably it is explained by immigration and low wage labor keeping inequality in the US relatively high. And then, of course, you have the usual picture, so I will not discuss it. Now, this is beautiful work done by Andrea Brandolini and Giovanni Vecchi for the Italian unification. They have actually gone down, even they have had a new methodological innovations. I will not talk about that now, but they've been actually able to trace Italian inequality throughout 150 years. Now, you see here the downward slope. You don't really see any sort of upward slope in the case of Italy, except, of course, after 1979, 1980, you see again in Italy, although much less strongly than in the UK and the US, you see this uptick in inequality. This is this part which I'm going to call, which I call the beginning of the second Kuznets curve, and that's the beginning of the upward slope of the second Kuznets curve. This is the data for Spain from Leandro. Lots of sort of action, but no really kind of clear story until 1950s or 1960s. Then, of course, the decline, very significant decline with liberalization under the Francoist era still, and then, of course, continuing with the democratization, and then again, the increase in the last 20, 25 years. This is for Brazil. Brazil is very interesting. I will speak, if I have time, a little bit about Brazil, because Brazil is interesting. It's a country with a decline in, one of the few, with a decline in inequality over the last 10 years. And Brazil and China, I interpret, you'll see China in a second, as examples of the countries that are actually at the peak, and I will give you maybe some reasons why I expect inequality in China to go down, at the peak of the first Kuznets curve. And actually, I think for Brazil, really, you can see it very well. This is one of my favorite graphs. This is, however, in time. Beautiful work by Javier Rodriguez Weber, who did this thing for Chile. So it's actually 200 years of Chilean inequality. You see the waves very, very nicely in this case. I just could not show this graph. And then the Japan, where we don't have as good data, but we have some data, and again, very similar pattern that what we have seen to Italy and elsewhere. So what is then the conclusion? The conclusion, is that, as I said, we can actually see the upsurge in current inequality as the beginning of the second Kuznets wave. What are the movements that lead that upward wave? Well, up, basically, because it's an upward wave. They're all listed here. I already mentioned them, but it's really, I think, a combination of what I call TOP, technological change, openness, and policy. And I also believe that it is vain to try to disentangle them, because I really think, to use a term that every self-respecting economist has to use at some point in his presentation, they are endogenous. Because really, you have policy, let's suppose low tax on capital is endogenous because you have globalized. If you have globalized, you cannot really tax your capital heavily, or it's going to flee away. So these things are going together, and the downward portion of the first Kuznets wave is really the factors that we know. Now, how, let me see, this is the graph which I think, a slide which I think, maybe it's my last slide, which I would like to highlight. It is really now trying to put the dates on these things. And what you see here, which I think is quite extraordinary, these are the peaks of the first Kuznets wave in the rich countries, all occurring either late 19th century. Spain is an outlier, very late, I mean, in mid-20th century. And then if you look at this approximate number of years of downswing, you see it's like between 100 and, in case of Spain, short, 30 years. For the case of the United States, 50 years. Now, what has been accomplished over that period? And we talked yesterday about the absence of a trade-off. And this is remarkable. You have had significant declines in Gini, which range for like at least 16 Gini points to 24. We are actually had halving of Gini coefficients in rich countries. At the same time, we have had an increase in mean incomes, which ranges from 4 times to 9 times. So this is really quite remarkable achievement that there is over the long term of 50 years or 100 years, there was really half of the inequality was sort of gone, reduced, and incomes have increased by a factor, in some cases like Italy, almost by a factor of 9. And of course, now we have a reversal. And this I listed there, whether this reversal is strong or modest and so on. So the last 2 points is, what do you expect then for China to happen? So this is actually China. And actually I said before, I expect China inequality to have actually plateaued. I expect the same forces that have brought the end of the first Kuznets wave to play themselves very strongly in China. On the United States, I don't expect that. And then, of course, the question you can ask me, maybe the US now is at the peak of the second wave and it should go down. Unfortunately, for the US, I really don't expect that, because I will list only, I will not discuss them, the 5 forces which actually, in my opinion, will continue pushing inequality up in the US. And they are increasing a share of capital income, continuation of very high concentration of capital income in the hands of the, obviously, top people. So we don't have capital widening ownership. That's the second force. The third force is the result of a new work by Tony Atkinson and Christoph Lackner that shows, this is a very remarkable force, that there is more and more of association in same individuals of high labor and capital income. This is really what I call the new capitalism, where actually the same people are both rich in terms of capital income and labor income. The fourth force is something which we have seen in the US and which is also sort of the obverse side of higher participation of women in labor force, and it is really assortative mating, which adds to the really strength of inequality. And the fifth force is greater influence of moneyed interest into politics, which of course attempts to make sure that none of these gains have been or will be reversed. So when I put all these 5, I really become very pessimistic about the reduction of inequality in the US, even in the second cycle. Thank you very much.
Thank you very much. Brilliant, Branko. Thank you very much, and the timing was just right. Now, Vamsi.
Okay, thank you, Anatol. I'd like to thank INET for inviting me to this event. What I'm going to present here was supported by INET, through a research grant, and I'm going to focus on Asia, Asian political economy in the 20th century. And can I take? What I'm going to present now is being written into a long manuscript form. This will, make the arguments more explicit. But since we have about 20 minutes, I'll present the outline of the model. The first point is, is there something that the Asian story can teach us about episodes of growth and inequality in capitalism? And what's fascinating about the Asian story since World War II is that there are 2, very different episodes of growth and inequality. Between 1950s and 1980s, Asia experienced an equalizing growth episode, and post-80s, Asia experienced a disequalizing growth episode. So when we put these two together, are there some interesting insights that we can gather? The second issue is, and I'm going to take a slightly different path than Branco. Are within country inequality dynamics, which is the focus of my presentation today, are they still a puzzle? And, should we sort of move, are Kuznets and Piketty adequate in understanding within country inequality dynamics? And, I'll try to present a slightly different model. And, like a good self-respecting economist, I have to use the term endogenous. What do endogenous crises in global capitalism, teach us? How do we connect global crises and, inequality episodes? That would be the main outline of my model. All right, so let me go through Kuznets very quickly in half a minute. I think we all know what the hypothesis was, and Branco also showed us, in all his slides about how, the hypothesis was valid in certain periods, and, one could continue to engage with it in multiple ways. It was very creative work. But, if you take the inverted U kind of a hypothesis, then, what you see by the mid 20th century, by 1960s, 1970s, is that there are two well-known anomalies that emerge. One is the Asian story, between 50s and 80s. Early growth in Asia is accompanied by rising inequality. And, of course, the developed nations, starting in the 1970s, witnessed rising inequality. These are two well-known anomalies. And, one could see it as an anomaly or as waves, as Branco just pointed out. So, one could debate this question further. But since Asian inequality story comes across as an anomaly to the simple Kuznets hypothesis, one way of engaging further on this question is to interrogate this particular anomaly and see, what it gives us. And, Piketty's work, we listened to him yesterday. I think it's, magnificent empirical work, for the developed world in particular. For the less developed countries, it's quite underexplored at this point in time. But, I don't want to go into great detail here, but the theoretical work is not convincing, it's not really convincing. I think there are too many problems or too many holes in the argument. Yesterday, Joseph Stiglitz pointed out the distinction between wealth and capital, and how, that can actually produce a completely different understanding. And he also talked about, one could also bring in or interrogate the question of, how is the rate of return to capital determined? Is it technically determined? Is it determined, by the larger political economic context? People have written, a lot of people have written on this. But, about the 20th century, what his empirical work shows is that it's a U-shaped pattern of inequality evolution. But in the long run, for the 21st century, unless it is checked, inequality is going to continuously rise. I think, these are the two empirical regularities that he observes. But then, he doesn't really offer much on why inequality switches happen. So, for instance, why did inequality switch in 1970s? I don't think, he has a lot to offer. He describes the process, but, what are the causal structures that work there? And, he also does not focus on endogenous deep crisis. By endogenous, what I mean is, internal to the economy. He doesn't focus on the endogenous deep crises in capitalism. He focuses mostly on exogenous shocks like wars or, the malign forces that Branco talked about. And interestingly, there's very little discussion on effective demand crises and what they would do to the system, like the Great Depression or like, the recent 2008 crisis. So, at the end of the day, without going into deep engagement here, I've developed this a little more in the write-up, for, this conference. The capital share of total income or, the rate of return on capital, these may be outcomes of deeper political economic frameworks alongside technical production processes. I think, Piketty derives alpha and R mainly from technical processes, but I think, these are determined by the deeper political economic frameworks too, and I'll try to argue that today. So the point of departure for my presentation is deep capitalist crises and the regimes that are instituted in response to deep capitalist crises would generate inequality regimes. And, in this particular context, can the Asian story shed some new light? So what's the, so let me start with the Asian story. Let's discuss it, briefly. And then, I'll give you an outline of, a different theoretical model. So I focused on 5 countries in this project, Japan, South Korea, Malaysia, China, and India. And there's a remarkable regularity across these 5 countries between 1950s and now, which is that, they all went through a U-shaped evolution of inequality during this period. Between 1950s and 1980s, roughly, inequality declined in all these countries, and post-1980s, inequality began to rise. So what's the connection with the global regimes? If you look at the global capitalist regimes during the same period, yesterday Joseph Stiglitz talked about golden age of capitalism, 1945 to 73. The equalizing growth episode between 50s and 80 coincided, of Asia, coincided with a progressive global regime, which one could call as the golden age, which was produced primarily as a response to an effective demand crisis, which is the Great Depression. I think the institutions that were created in response to Great Depression, and I think that there are certain aspects. I'll come back to this point. The second episode, post 1970s or post 1980s, is a disequalizing episode, and this in Asia, and this coincides with a global regime which is produced by a profitability crisis in the late 60s, early 70s. I think the system was restructuring itself and coming out with a new set of institutions in response to a profitability crisis, and this goes alongside the destruction of the welfare state, or the weakening of several pro-labor kinds of policies or institutions, especially in the global capitalist centers. If you look at the Asian story, what were the local national political economies? The important point is before 1980s, after 1940s, what you actually get is, developmental states in Asia, which promoted labor-intensive industrialization, and, it was largely equalizing growth. I think, this has been pointed out, in several documents. World Bank came out with the East Asian miracle story. But the backdrop is that of a progressive global regime. And one other important component of the global regime was, socialism was on the rise and it had to be countered. If you look at the Asian stories, whether it's South Korea, whether it's Malaysia, Indonesia, there was very strong intervention with the assumption that, socialism could take over in Asia, and, that had to be countered. So that also played a key role. Post-1980s, on the other hand, in the Asian economies, what you see is a strengthening of urban capitalist classes and urban professional elites. And I'll show you a couple of interesting tables from China and India, which come out of my research. There's an emergence of these elites, which took advantage of the new global regime that came in response to the profitability crisis. And the important thing is socialism was also declining. I think, you need to keep these two factors in mind, when you think about the local political economy. Okay, so 1950s and 80s, I think it's now well known, Alice Amsden, a lot of people have worked on this. Asian economies were primarily state-led and they pursued labor-intensive industrialization, but it all started with, very progressive redistributive land reforms in the 1950s across several of these countries, but especially in East Asia. And then, there was a protection of small-scale producers, whether it was peasantry or artisans, and there was also provision for internal migration for rural populations to migrate to urban spaces. There was active employment, very high employment creation, and there were several other active interventions. So this growth also happened in a regulated global capitalism that came up in response, as I already said, to effective demand or the financial crisis of the Great Depression. There was a lot of aid that flowed into East Asia during this period from the US and from Europe. And there was also cheap oil. There was the exchange regime was fixed and the terms of trade were favorable to these countries. These are important factors about the global regime. By 1980s, the same regime produces, a strengthening of, forces that strengthen indigenous capitalist classes and, professional elites. And by 80s, they are in a position to articulate a very different logic. And, you see, the elites in these countries connecting with the new global regime that comes into being by 1980s, the neoliberal global regime. And growth has been disequalizing in these countries. And there's been sort of an enclave kind of growth in several of these economies. Let me show you a couple of tables. In the case of China, and these tables are based on household surveys, so we don't have the top 1% here. We do not probably have the top 2% also, or top 5% even, but still you get a remarkable story. What I would like you to look at in this table is, it's a simplified class scheme. One could experiment with multiple class schemas from the household surveys in China, the CHIP surveys. The first column is 5 classes, 2 urban classes, urban elites, urban workers, and then 3 rural classes. The second column is 1988, which is the first data point that's available, for careful micro-analysis of the Chinese household surveys. And these are what you see, the numbers there are basically the class means. What's the mean of the urban elite, what's the mean of the urban working class, and so forth. And at the bottom you see the population mean. The next column is the ratio of the class mean to the population mean. Okay, and you can see the same thing for 2007, which is the last data point that's available for micro-analysis at this point in time. The very last column is, what happened to this ratio over time, the mean ratio, what happened to it, for different classes. And the story is clear, the relative gains from growth are captured entirely by, the urban elites. You actually see no other class, emerging in relative terms, vis-a-vis the other classes. It's the urban elites that really, this is the outcome, of the argument I'm making. Look at, the Indian story. This is based on consumption data, and Indian inequality figures are comparatively lower, than the Chinese figures. But, look at the story that the consumption figures actually tell you. Again, these are classes in the first column, and look at what happens to the ratio between 1983 and 2010. Urban elites completely, dominate in terms of, the relative gains from growth. And this is the enclave, that was produced in several of these countries. And, so the growth episode between 1980s and 2010 in several of these countries is an enclave growth kind of an episode. And this is what, causes, disequalizing growth. And this enclave, you can view it in spatial terms. You can, if you go to Indian cities or Chinese cities or, Malaysian cities, you can see it in spatial terms. You can see it in income terms. You can see it in cultural terms. But, it's this enclave that has really taken away, the gains from growth. And that's what causes, inequality, the disequalizing episode. So what's the theoretical model? What's the outline of a theoretical model that we can construct? Changes in within country inequality seem to be determined by 3 processes, basically. One is deep capitalist crises, whether they're exogenous or endogenous, and what are the institutions or regimes that arise in response to these crises, and the particular national or local political economies that exist. It's a combination of these 3 that produce inequality regimes. And what we can see from the history of the last 150 years in capitalist centers is the following. There have been 4 deep crises, and each crisis brought about new inequality dynamics in the centers. So the first is the long depression. A lot of people thought capitalism would never come out of that crisis. between 1873 and 1896. It was a profitability crisis. There's a lot of interesting work on that. And post-profitability crisis, you see the emergence of a new set of institutions in different capitalist centers and even the US, different organizational forms, and a lot of people, Eric Hobsbawm, even Thomas Piketty, referred to the post-1896 period as the belle epoque, beautiful times for capital, right? I mean, that's the, whose beautiful times were they? And inequality rose, post-1896. And if you come to the Great Depression, the post-Great Depression period, especially, post-World War II, when new institutions were created across the world and within countries, you see a decline in inequality. So, this was basically a response to an effective demand kind of crisis, and it produces a certain set of dynamics and, brings together certain sets of institutions. And then, 1960s and 1970s, late 60s, early 70s, you see the stagflation, or, what a lot of critical economists or heterodox economists have identified as profitability crises. That happened during that period in the capitalist centers. And post-stagflation of 1970s, you see inequality rising. And the fourth deep crisis, okay, I'm almost done. Yeah. The fourth deep crisis, is the 2008 crisis, and it's still not clear which way the inequality dynamics are going to move. As of now, inequality is still on the, but this is a question that's going to be debated. I think that's what we are debating really. Which way should inequality dynamics move? What are the kinds of institutions that we should create? And I don't think, this is a settled question yet. I think this is an open question. So the process seems to be, within the capitalist centers, a crisis produces a sort of molting process. Molting is like, the institutional skin of the system is slowly shed, and, a new institutional skin is grown, the way snakes go through this process. And a different regime is created. And, ideas also change. New sets of macroeconomic theories come in. The Great Depression produced a Keynes. The 1970s, saw the return of the classicals, Milton Friedman, and, a whole range of theories that came after that. So, if you look at the observed pattern, you can make one or two more interesting points. One is that the crises over the last 150 years are oscillating. This is a pattern that we observe from the past. It doesn't mean that, future will follow the same pattern. They're oscillating between profitability and effective demand kinds of crises. If you look at the last 4 deep crises, and inequality regimes are also closely following these crises. Effective demand crises tend to create a structural possibility for greater equality. Profitability crises, structurally create conditions for greater inequality. But, so far it appears as if, solving profitability crises will set up the next effective demand crisis. Solving the effective demand crisis sets up the next, profitability crisis. So, can we think of a regime within capitalism? And this is something that was being raised last night. Is the recent crisis a crisis in capitalism, or is it a crisis of capitalism? This is an important question. So, can we create a regime that can transcend, both these crises and be somewhat stable over time? And, if you move away from the centers, these crises and these responses seem to travel to different countries, through transnational outsourcing or trade or finance or multilateral institutions, or, between 1950s and 80s, the very fact that, it was a progressive global regime meant that, a lot of national states had policy autonomy. They could experiment with, national development policies, and the response also from the local political economy mattered significantly. So, to conclude, the 2 global episodes, inequality episodes since 1930s, and the 2 Asian episodes since World War II largely coincide, and they bring out the interaction between the local national dynamics which are embedded in the larger global dynamics. It's neither U nor inverted U. I think, if you look at the relation between inequality and, income, it's neither consistent rise nor decline. I think the correct long-term relationship should be understood in terms of the structural possibilities that exist at the intersection of the global and local political economy. I think this is key to, and the kinds of crises that happen and the kinds of institutions that are created in response to these crises. It is a non-deterministic model. Pre-1970 Malaysia, before the race riots happened, between the Malay people and the Chinese people in 1970, inequality levels rose in Malaysia. So, even though the overall regime was progressive, Malaysia had a different story to tell. 1980s, until almost late 1980s, both India and China experienced equalizing growth. And of course, the 2000 story of Latin America, while the rest of the world was countries in the rest of the world were becoming more unequal, Latin America took a different path. So local political economy is key, and it can produce different outcomes from the broader outcomes that we are talking about. But structurally, today, if we talk about the present, we are coming out of an effective demand crisis. So there is an imperative, I think, structurally for greater equality. But what we see is austerity policies across the world. So it's a political economy question, I think, and when it becomes a political economy question, how do classes that lost out regain their shares in the coming decades? And so political economy questions will never be fully resolved in the economic domain. Probably there will be a political aspect to the resolution of how we are going to create a new stable regime. Thank you very much.
Christina.
Yeah, thank you. Okay, so as you have just heard, during the past decades, income differences increased significantly across a number of nations, and I'm sure that most people in this room could in fact name quite a few countries in which income inequalities rose in the last years. However, by dropping the first letters of the term inequality and addressing the question where has growth led to equality and why, this first panel tries to start this conference on a high and positive note. As Branco Milanovich has pointed out in several papers, there's indeed some good news. Despite increasing income differences within many countries, global income inequality as measured by the Gini index and other summary statistics slightly declined during the past decades, or at least did not increase between 1988 and 2008. However, although countries have become increasingly integrated and interconnected over time, in a world of nation-states, most people are probably still first and foremost concerned about their relative income position within their respective country. In the end, individual incomes are influenced by global and country-specific market forces, but also shaped to a large extent by national governments and local institutional structures. So, looking at income inequalities within nations, can economic growth really lead to greater equality? Does a rising tide lift all boats, especially those at the bottom of the distribution? From a theoretical point of view, the distributional impact of economic growth at the national level is far from clear-cut. In fact, it is usually not growth per se which alters income dispersion within nations. Rather, distributional changes seem to be dependent on both the type of economic growth as well as the underlying transmission channels. For example, the standard textbook theory suggests that globalization-led growth leads to increasing gross wage inequalities in developed nations and declining wage dispersion in developing countries. On the other hand, growth which is accompanied by offshoring may favor those at the top of the income distribution in both rich and poor countries. Similarly, technology-led growth may bring about rising labor income dispersion when the underlying technological progress is skill-biased. Furthermore, as a country develops and grows richer, it is likely that several structural, institutional, and political changes occur in the economy, which may in turn have an impact on income differences both before and after taxes and transfers. A more recent approach by Thomas Piketty classifies economic growth as a potential factor of equalization, as with high economic growth, incomes and wealth accumulated in the past may become less important in relation to current incomes. At the same time, there also remains the possibility of reverse causality, as changes in income inequality may affect economic growth. Within an economy, it is likely that several counteracting mechanisms coincide. So in the end, the nexus between economic growth and income inequality is an empirical question. In fact, most empirical studies do not find a clear link between economic growth and income dispersion. While there are countries in which income inequalities declined with economic growth, there are other nations in which economic growth was accompanied by rising income differences. Eventually, the relationship between inequality and growth must be highly complex and probably reflects the impact of a number of country-specific changes occurring as nations develop and grow richer. So, theoretical and empirical studies do not identify a clear link between economic growth and income inequality. However, as we have just heard, there is a much more homogeneous pattern of within-country inequality developments across time. For example, top incomes have increased significantly across most Anglo-Saxon countries since the 1980s. To a lesser extent and with some time delay, this trend is also visible in some continental European countries and other economies around the world. In light of such similar inequality developments across a number of nations during different periods of time, Vamy Valu Branam addressed the influence of changing global institutional structures to explain within-country income inequality evolutions. Certainly, especially as the world has become more interconnected during the past decades, the global environment is increasingly influencing within-country conditions. However, there are also some nations which bucked the recent trend of increasing income inequalities, showing that countries are not necessarily at the mercy of overall global trends. Rather, when sufficiently strong and designed properly, national policies and institutions can indeed lead to reductions in income inequality both before and after taxes and transfers. For example, contrary to the trends in many countries across the world, income inequalities have been declining in a number of Latin American countries since the early 2000s. At the same time, economic growth rates have been relatively high in some of these nations. Although there are differences from country to country, most analyses agree that the general reduction in labor and non-labor income inequalities across Latin America was due to a combination of institutional factors, market mechanisms, educational policies, and changes in government social spending behavior. In general, skill premiums for skilled workers have been falling, caused by both demand and supply-side factors. Furthermore, public expenditure per student in both primary and secondary education increased significantly in a number of nations. In addition, rising and more pro-poor government spending, especially in the form of conditional cash transfers, led to declining inequalities after taxes and transfers. Eventually, changes in the distribution of incomes in the course of a nation's economic development depend on a variety of factors and are highly country-specific. Nonetheless, it may be argued that economic growth has the potential to act as a social modifier. Regardless of income inequality developments, as compared to a low-growing economy, in a high-growing economy it is more likely that the absolute incomes of all people increase over time. In a country with weak economic growth, there might be a higher risk that only top income groups gain from economic growth, whereas absolute incomes at the bottom of the hierarchy do not change at all or even decline. From a social point of view, a high-growing economy in which both the absolute incomes of all people as well as income inequalities increase over time might be preferable to a low-growing economy in which income inequalities rise, but only the absolute incomes at the top of the distribution increase. Indeed, economic growth prospects are not looking too bright in many advanced countries. During the past year, several economists have pointed to the issue of secular stagnation. A most recent IMF study mentions that lower potential growth might be a new reality in both developed and emerging market economies. When looking at redistribution, it is obvious that the financial capacity of governments usually increases with higher economic growth rates. This, in turn, may facilitate the implementation of redistributive social policies targeted at the poor and most disadvantaged. As pointed out by several studies, policies designed to reduce income inequalities go far beyond changes in tax schemes and cash transfer programs. In fact, it is more about promoting equality of opportunity. Furthermore, as shown by the OECD, there does not need to be a trade-off between greater equality and efficiency. Equality-enhancing policies, which are likely to boost economic growth, include, for example, promoting equality in education and the integration of immigrants, investing in early childhood care, and improving labor market outcomes for women. To close my comment, economic growth can indeed be accompanied by lower income inequality. As the link between economic growth and inequality within countries seems to be country-specific and influenced by national policies and institutions, separate case studies for individual nations are necessary to better understand the underlying mechanisms. Thank you.
Great. Thank you very much, Christina. So we now have about half an hour for a discussion, questions from the floor. I'll ask one question, but please, everybody else now, prepare your points. To me, the common thread through all three of your comments, and particularly the two main speeches, is the political economy aspect of it. That we are not talking about deterministic, economically endogenous deterministic process, although we may be talking about a political economy and endogenous process. And the question I wanted to ask, really coming out of Vamsy's presentation, and I wanted to ask you, Branko, how you react to it. I like Vamsy's presentation very much because this four-crisis structure of the inequality wave is quite close to something I wrote a book about 4 or 5 years ago, again looking at sort of four crises of capitalism since the early 19th century and talking about the way that economic ideas and economic institutions evolved from each of those crises, precisely the same crises that you outlined, Vamsy. But the way you characterize those crises are the profitability crises alternating with the effective demand crisis. Now, what that leads to, and the question I wanted to ask you, Branko, you ended up with a quite pessimistic outlook for the US and other developed countries with your 5 points of reasons why inequality is likely to widen rather than narrow. How do you react to the idea that we have now had this effective demand crisis? And of course, the initial effect of it has been to aggravate unemployment, aggravate inequality, and so on and so forth. But that actually the longer-term political economy effect of it may turn out being, which is I think what you were suggesting, Vamsy, more like that of the 1930s, that you have endogenous political changes coming about which lead to a narrowing of inequality rather than widening. What's your reaction to that, Branko and Vamsy? Have I correctly characterized what you're saying?
Who should start first?
Yeah, you.
Okay, so yeah. Okay, 2 points. The first one, I didn't have time to sort of belabor that point, but the downswing of the Kuznets curve from the peak in the late 19th century to actually 1980 was extremely sharp, and I think it was sharp because there were two forces behind it. One was the malign force of the war, and it's a pretty ambitious book. Actually, I tried to explain also why the war happened. So I will not explain it now. But that was certainly a very strong force for all the reasons that we know. So I don't want to go into it. But that force led to, of course, a number of social policies which are very progressive, trade unionization, much greater participation, of course, women in labor force, collective bargaining, co-determination, which were essentially the result of the war and social pressures, and as Vamsy said, also the presence of the Soviet Union, an alternative model of society. So there was a unique element where actually time where we had both of them going on. Now, going back to your both forces of malign and benign forces of the decrease of inequality. Going back to the current events, I think actually in a very, very long-term picture, I cannot say that the current crisis, and if you look at these numbers there, it's not something which actually stands out. It stands out for the rich countries because there was a decline in mean income. The numbers in the Gini and others don't really change very much. I mean, some of these statistics are somewhat misleading because when we have a statistic that like 90% of market income, not disposable income, gains, have gone into the hands of the top 1%, it is because there was absolutely no gains to be made. The gain was like this much, like $3, and then $2.70 of that $3 was taken in the market income of the rich market, because disposable is not the same. So, in the long term, you don't see it. Now, the question, I'll answer it directly, it's very difficult, actually, it's impossible in such great sweep to say it is a cop-out. If I were to say this is going to lead to political pressures which would then reduce inequality. I really cannot see it. And when I started looking at the US, that I know better than the other countries, I actually listed these 5 forces. And, you know, it's kind of overturning each of them would be hard. Overturning 3 out of 5 would be very, very difficult. So that's why I'm pessimistic. But eventually, if you believe in the Kuznets waves, of course, they would have somehow to go down. Now, if you ask me how will they go, I actually have 2 possibilities there. Maybe I'll come up with more. Is the standard one of race of education, supply of education, and technological change, because that was a burst of technological change. It's not going to keep on going forever. And the second one is an interesting one, is sort of the forces of convergence, which would bring China and India and others closer to the Western incomes, and hence would stop this process of the hollowing out, which I believe is driven by their rise. So there would be like 2 answers to that.
Vamsi.
So thanks, Anatol, for the question and comment. My own, the way I framed it is, that, there is a structural possibility, right, for greater equality, after an effective demand crisis, because, especially if the effective demand crisis is accompanied by a financial crisis, the possibility of creating demand through asset bubbles, that's not very strong, at least, that you cannot do it for a very long period. So that would create some internal systemic pressures towards income redistribution, right? And, but then, it's not a mechanistic process. This will happen only if there is, sufficient resistance, and the political economy forces have to work out. So the big puzzle, at a systemic level, and I think that's what INET has been debating, right after the crisis, there was a 2-year window when things were very optimistic. That's when INET was created. A lot of people were talking about Keynes. Marx Capital became a bestseller for a little bit, right? So, but then, that window closed. But once the window closed, around 2010, what are the new avenues for creating effective demand? So this is the question. I don't think, that question has been addressed or answered, in the new, configuration that's emerging. So if you begin to address that question carefully, I think, pressures to redistribute will also emanate. But that will, the urgency of that question will come to the, will become important when there is a larger political kind of resistance. And I'm not saying that it will happen, but, there is a structural possibility. Yeah.
No, I think that your very last comment, well, it certainly accords with the way I'm beginning to think that the reason that there is a growing concern about inequality, which I think will continue to intensify, is precisely because of the link that has been made between inequality and effective demand. And so much of the anxiety about secular stagnation, when you analyze it properly, in my view at least, is a demand-side anxiety rather than a supply-side anxiety, and it, with time, I think, will begin to focus in increasingly on the inequality and on the difficulty that the top 1% have in spending 20% of the income. Yeah. Please, other questions, yes, and comments, yeah.
Yeah, in this case, you're also allowed to make comments, unlike yesterday.
All right. Actually, I'll stick to a question. Thank you for the excellent presentations and discussion so far. I wanted to follow up on one point that came up in a way. Oh, yes, Jim Boyce from the University of Massachusetts, Amherst. Something that came up in both Branco's and Vamshi's presentations. Branco referred at the end in his 5 points for pessimism in the United States. As American, I found those very depressing but unchallengeable. One of them was the concentration of capital. And I would single that out as, in certain ways, one of the key pieces, and a piece that if there were to be any kind of political move to counter the influence of money over politics, if people were to be mobilized in the phrase Vamshi used, that would be an arena where some efforts to broaden ownership of capital would be one way to reduce inequality, broaden effective demand, and so on. And Vamshi, in his presentation, mentioned that in the East Asian experiences in the post-World War II period, land reform was one of the critical pieces that, that was put in place that resulted in that period of rapid and egalitarian growth. And so what I wonder is if either of you have or any of you, not just the two speakers, have thoughts about what possibilities there might be if one were to try to articulate some program for an alternative economic strategy that included, or perhaps even hinged on, broadening of ownership of capital as a strategy for redressing inequality and building effective demand and building a more stable economy. What exactly would sort of policies could you envisage that might be the centerpieces of such a strategy?
Be quite brief on that. I'm very glad that you brought this up, because we have been so conditioned to believe, which is based on facts, you know, when we talk about rising share of capital, we immediately assume that it leads to greater interpersonal inequality. And it indeed does, but it does because capital is distributed in such a peculiar way that it's very heavily concentrated among people, who are rich. But a broadening of the capital base, technically speaking, let's suppose that everybody had the same share in total national capital, then an increase in the capital output ratio or the increase in the share of capital in national income would not be a problem. It would be an equalizing move. The fact is that actually that's not how capital is distributed. Now, moves to broaden that, I can imagine, I really don't know, but I can imagine that many tax schemes could enable that much greater participation of workers in capital of the enterprises, either where they work or they can invest and so on, or small investors and all that. However, I have actually just to remind, of course many people know that when Margaret Thatcher came to power in the UK, that was this people's capitalism, of which we heard for about 2 or 3 years, and then nobody talked about that since. It's obviously, there was a failure to broaden that, actually. And eventually you had not lots of people, I was recently talking to somebody, lots of people who have some ownership, but you know, when you do that concentration curve or you do a Gini coefficient, this is really tiny. It really doesn't make any difference. So I totally agree. This is one of the venues whereby you could actually, these 5 forces, you can actually check that force very effectively if you were to broaden capital ownership.
I agree with Branco, Jim. I just want to add 1 or 2 small things. One is, I think it's a much harder political project, to start with the objective of broadening, capital ownership than, to try to improve the workers' wages or, incomes of the working people. But I do see that as an important project. And, one of the ways, and the crisis itself in the responses that it produced from the workers. For instance, within the US, a lot of workers, formed cooperatives, they took over factories. There were examples, that came from Chicago or Wisconsin, and different places. That's a particular kind of movement that could potentially democratize ownership or, broaden capital ownership. But will it make a huge dent on the 1%, top 1%? I'm not sure. And that's a difficult political project too, I think. Yeah.
I'd just like to make a remark which perhaps is a little controversial on that point. And it's triggered really by your comment about Margaret Thatcher. There was actually a tremendous broadening of capital ownership, certainly in the UK, where I lived for most of the 80s and 90s, but probably also in the US, and that was through the ownership of residential housing. Now, of course, if you look at residential housing, which is by far the largest element of the capital stock in any case, in any economy, there has been a broadening of ownership. And the slightly technical question I would ask you coming out of that is, To what extent do these income distribution figures, Gini coefficients and so on, take into account the implicit income, the owner equivalent rental income from housing?
Well, in most countries, they actually do,
Yeah.
This is not done ideally because you have, oftentimes you actually ask people what would have been the rent that they would be paying, which of course is not always reliable or whatever. But in principle, the data do include, actually, it's a large component. In some cases, it's not included, but most cases, actually, in very poor countries as well, it is included. So it is, we had problems, for example, in Nigeria, I remember, is a big problem, data in Nigeria are very bad, but, that was, but in rich countries, it's included.
So in the US and UK,
in the US,
it's not
UK.
just cash income.
No, it's not. No, it is actually imputed value of housing,
okay,
or, everything else, which is imputed, of course, cash, near cash benefits and so on. Can I just make one point actually on that? I totally agree with what you said about housing. But of course, I think we had here more about talking about broadening ownership of K, not only of W. And ironically, I think what might happen is that my point 3, whatever, is that you can actually, ideally, we would like to have a society where everybody has more or less the same share of capital income and labor income. Let's say that's the objective. But really what is happening is it is happening at the top. It's the rich people who have very high labor income, they become also rich capitalists. So it's actually an ironic situation. It's not happening, this unification of labor and capital is not happening at the bottom or in the middle. It's really happening at the top.
And that happens even when you take housing into account.
Yeah, it happens. It's actually simply that there are people who are, this is actually, you can see them in Piketty's data as well. The share of labor in the top 1% has historically risen.
Okay, well, I have two questions which I'd like.
Who you are again?
Well, I can't claim any affiliation to a university because I'm retired, but I am the author of a book called Contaging, if I'm allowed to say there's any affiliation without being accused of promoting a book. I have two questions which I want to just defer one question until later because it's a bit like your housing criteria in the wave formula. But my question that I want to position is in regard to the confiscation of wealth. And this is through the systematic redistribution that has happened. We can't deny it's happened. And so I want to question about the loser, who is unable to challenge that confiscation of wealth and unable to challenge the political elite who have the political and legal advantage. My question is, has the window closed on the political pleb or the political neophyte? I have no idea as a neophyte how to deal. I think you've referred to this in terms of class and the disadvantage that they've achieved.
What do you mean by the confiscation of wealth?
Well, this would come back to the second question, which was, have you taken into consideration the banking system and the tax arbitrage that has taken place over the last 15 years in your wave theory? My position on the wave theory of tax arbitrage is that we are in the second wave right now, where the first wave was simply principal and interest. The first wave of confiscation was interest through tax arbitrage, where the system took away from public wealth. And now we have a position today where we have the public wealth having had to pay the bailouts to the bank. That's a confiscation of public wealth. And that's the second wave which we're in right now. I don't think we've seen the full end of that. And there's probably another consequence for it. So they are related. I don't know how you can solve one without the loser finding some way to get back the political advantage that they lost.
So what are the distributive effects, if any, of the financial support bailouts that have happened over the last 8 years?
Maybe
I'll be saying one sentence. I have not worked on that. I suppose that there must be regressive because obviously taxpayers were paying money and of course the beneficiaries were people at the top. But I have not seen empirical work.
Any other comments on that?
I don't really have a question, but more a suggestion. When I was looking at your presentation, I'm sorry, my name is Filipina Weisvis. I'm related to the Pannonia University in West Prem in Hungary. When you mentioned the, let me check, I wrote it down. Are you aware of research on norms and values? Because I noticed that you mentioned influence of education. And Professor Hofstede did a lot of research on values and also relation of values and power. And there is a calculated inverse correlation between educational level and the acceptance of inequality. Now, I thought there might be a possibility, at least it's striking, that the educational crisis in US coincides with the widening of the equality gap. So it might be another interesting angle. So it's supported by research on norms and values.
That's very interesting. The inverse correlation between the level of the bottom seems to be coming from the middle and upper middle level. It's not coming from the top.
I'm not sure that empirically it's true. If you look at Page, you know, and Bartels, this is a little bit, I think, urban legend. You know, smart people, educated people want to reduce inequality. But if you look at hard facts, actually, in their books, actually, the support for low taxation is much stronger among rich people, so they're not stupid, you know. And what you have is that when you fix, for example, education level and let income rise, their likelihood of voting Republican increases. So it's actually, it's a little bit, I think, of an urban legend, I believe. When you fix education with increase in income, you are actually less likely to support taxation. But I don't know, you know, it is actually multiple correlation. You cannot, you have to actually fix several things. So I'm not sure about that.
Hello, I'm Caroline Pauner from the OECD, and I just want to get back to the capital ownership issue and also like maybe endogenizing it, as that seemed to be like one of the things. Because if we're thinking about today's economy, then maybe we're thinking about a slightly different way of what is getting rewarded in this economy. So I'm thinking if you compare it to like if we admit that there's something changing in what is the value that's being created from the past, where the big producers would be manufacturers with factories employing large numbers of people, and now we're talking more about like the Facebooks who generate huge profits but don't employ half as many people, and we're talking about scale, getting to scale without really needing that much employment. So even if whereas we might be thinking, well, if you have the capital and you can invest, that's where you get many of the rewards. So that really generates probably a very different role also for technology and the changes that I didn't see that much reflected in some of the discussions. I was wondering about your views on that.
Well, briefly, if I really got it all, you mean like basic issues like jobless growth? You know, my presentation is obviously at a very high level of abstraction, you know, so you cannot go into all the details. And as I said, really, even the crisis shows in such a big sweep, really as not much And I was maybe always very skeptical about this use of the word crisis, because until recently, the world actually, there was a crisis of the North Atlantic economies. It was not a world crisis, because the world has been doing pretty well. Now we are maybe seeing slowing down, but if you look at actually average world growth rate, it has been at 3%. And per person, it has been at 4%. But going to this, actually, I don't know. I'm not as negative in the following sense. I see this evolution as essentially evolution to some extent of human needs. We started with textile revolution because agriculture because we needed to eat, textile because we needed to be dressed, manufacturing because we needed things, cars, pens, things like that. Well, now we basically need games. And so I see it as a result of our sort of fulfillment of the earlier needs. So I don't see it as something which kind of, it might have other implications. You said maybe we need fewer people per each individual game. Maybe things can be actually done many times over with the simple input of labor. There may be some implications of that kind.
No, just connecting this question and the earlier question, I think, the political resistance from, let's say, educated people, it may not happen, automatically, but, when a jobless growth kind of a process attacks, decent jobs that are provided to educated professionals, I think, that's when it becomes a real political economy issue. And, they will get activated, or they may get galvanized into political action. And I think that's what you actually see in the Occupy movements, or in Arab Spring, or several movements that have actually what has happened in Greece. I think these are people who are already educated, people who thought education would get them decent jobs. So there's there's something about the economic model of the last 20-30 years that has devalued. If you go to a country like Japan, 1/3 of the workforce is part-time, and several of them are highly educated. They have engineering degrees, they have professional degrees, and they pursue things assuming, their education, assuming that, their lives will not be different from, how the parents were treated in the job market. But, there is something else that happened in this, in the last 2-3 decades in this new model. And I think, that's really hurting even the educated professionals, So that is the connection, I think, with the political economy. Yeah.
The other comment I would make on that is that the type of capital and the returns on capital that are coming out from this new economy, I think, are rather different from those in the first and second industrial revolution. And this struck me very much in the discussion yesterday when, both Stiglitz and Piketty were talking about the very large role of rents in the returns on capital, and that this is a sort of unproductive part of capital as opposed to the productive capital. But I would, as they said that, that's rather challenging reflection, came to me, which is that it's very easy to describe the rents on property, whether it's agricultural property or residential property, as being unproductive. But actually, a very large amount of the capital value that we see now in our economies, not just in housing or land, but actually in corporate capital, is actually a reflection of rents. And this is the answer. Facebook is a pure rent extraction enterprise in the sense that it doesn't produce anything. It has an extremely powerful and perhaps well-merited monopoly position, but because of that monopoly position, it is able to extract large rents. If you could imagine a competitive market with 100 Facebooks in the world, none of them would be nearly as profitable as Facebook is. Similarly, Google, similarly, Apple. The reason that Apple is worth $1 trillion is because of the protection of intellectual property, which prevents anybody else coming along and making an iPhone and selling it for $100 rather than $600. Now, in a sense, these are quite productive. These are quite constructive rents, or one could debate whether they're productive or not, but it is a different type of return of capital from what you saw, when GM would put up a factory, building 100,000 cars. So I think that may also, I'm not sure how that plays into this discussion, but I think it is a new phenomenon.
I would just like to say one thing, actually. It does produce something. I agree with you, the intellectual property rights limit the ability to challenge Facebook or whoever. I'm a big user of Twitter, by the way, and you should follow me. Yeah. But it does produce something. It produces utility.
Absolutely, yeah. No, I'm not saying it's unproductive, but it is protected by monopoly.
Right.
That's it.
Traditionally, productive capital, was engaged in producing, commodities, whether they're, manufacturing goods or even services. But, post-70s, apart from financialization, which is going to be debated this afternoon in several panels, you also see the rise of merchant capital. After the demise of British East India Company, this is the first time, since 70s, that merchant capital has become so big.
Yeah.
You don't see these, they were all, small players earlier. Now retail players have become so large, right? And land, so finance, merchant, these are different kinds of, one could argue, unproductive capital, not useless, that's not how it's being used. But, you go back to Smith or Ricardo or Marx, that's the distinction they make between productive and unproductive capital. And, I think it's the rise of unproductive capital, which, characterizes the last 3-4 decades. Yeah.
Well, we've run out of time. Christina, I'm conscious that you haven't had a chance to say. Would you like to make any comments on anything we've been talking about?
Capital income is a huge issue, right, at the top of the distribution, although labor income has become more important. But I think inequality in itself is not bad, but what we see in many advanced countries at the moment is that we have this inequality of opportunity, because if you were in the right initial position, you have a huge advantage, and it's actually quite hard today to rise from the bottom to the top. So that's a huge issue, I think, and this inequality which we have in opportunities. So yeah.
Okay, well, thank you.